In one trading day, silver didn't just fall, it fractured. On January 30th, 2026, the price was reported to have dropped 27% in a single session after racing to roughly $121 an ounce earlier that same month. Not months, not weeks. In 48 hours, a market that normally moves in slow, stubborn increments behaved like a tech stock in a flash crash, slicing from euphoria into free fall and then snapping back toward the high 70s as if reality itself had been briefly unplugged and rebooted. For years, the comfortable story was that silver could surge, yes, but it couldn't do this. It couldn't swing that far, that fast, without something breaking behind the curtain. And yet it happened anyway, in plain sight, on the most liquid, most watched venues on the planet. The strangest part isn't even the drop. The strangest part is what the drop revealed. The people who manage risk for a living reacted before most viewers even realized the rules had changed. Because while headlines were still catching up, the machinery of the market was already moving. Margins were being adjusted. Liquidity was being rationed. Positions were being forced to shrink. And on the very day silver was collapsing, billions of dollars of attention and hundreds of millions of dollars of retail flow were still pushing into the most popular silver vehicles, as if buying the dip was the only script anyone remembered. Here's where it gets interesting. The real question is not whether silver moved. The real question is why it moved in that specific pattern, and why the physical world and the paper world started telling two different stories at the exact same time. What I'm about to lay out changes how this entire episode looks, because the snap wasn't random. It was a stress test, and it exposed who was positioned for the rules and who was positioned for the story. Welcome to Signal and Noise, where we decode what matters before it becomes a headline, and we separate price from mechanism so you can see how the game is actually played. If you've been watching this from New York, Mumbai, London, Dubai, or a small town where the only chart you see is on your phone at night, drop a comment with where you're listening from. And if this kind of forensic breakdown feels like that wise elder who explains the world without yelling, you already know where the subscribe button is. Now let's reconstruct the event like a crime scene. The run-up came first. Silver pushed into levels that felt unreal, and the velocity itself became part of the story. A move to around $121 an ounce in January was not a normal bullish trend. It was acceleration. It was the kind of move that pulls in momentum money, short-term traders, options chasing, and leveraged futures positions that assume the next candle will behave like the last. Then, January 30th hit. The price action was described as the biggest one-day fall on record in that reporting, a 27% collapse that turned a chart into a cliff. That kind of move doesn't happen because a few people change their minds. It happens when the market is forced to clear at any price because the people holding risk on margin must either add collateral immediately or liquidate immediately. And when enough of them choose liquidation at the same time, the bids vanish. But the collapse was only half the story. Almost immediately, silver bounced. Not gently, it snapped. That rebound is the clue most people skip because they get hypnotized by the drama of the crash. A snapback tells you there was demand sitting underneath, waiting, but it also tells you something else. The sell-off wasn't purely fundamental, it was mechanical. So what was the central mystery? Why would a metal that had just sprinted higher suddenly get slammed so hard only to rebound, while at the same time, parts of the physical market were signaling scarcity? Why would one region price silver at a huge premium above another region's benchmark if the metal was supposedly abundant? And why do the institutions that run the plumbing respond with rule changes, right as the volatility exploded? To answer that, you have to stop thinking like a chart watcher and start thinking like a risk manager. Silver is not only a commodity, it is a collateralized bet. Futures positions are controlled with margin, and margin is a lever. When volatility rises, the exchanges raise the cost of holding that lever. That's not a conspiracy. It's how clearinghouses survive. After the plunge, margin requirements were raised on major precious metals contracts. That one sentence matters more than 1,000 hot takes, because a margin hike is a forced deleveraging signal. If you have the cash, you stay. If you don't, you reduce. And reductions in a crowded trade are never polite. This is not the first time silver has played this exact script. In 1980, silver's price surged into a historic blow-off and then crashed hard. The details differ, the era differs, the headlines differ, but the sequence is familiar. Rapid ascent, public fascination, leverage participation, and then an abrupt tightening that turns leverage into a trapdoor. The outcome was not merely lower prices. The outcome was a multi-year hangover where belief itself got liquidated. Then in 2011, silver ran again. It climbed with speed that felt like a once-in-a-generation squeeze, pushing toward the high 40s. And then, in a matter of days, it broke. Margin requirements rose, volatility spiked, forced selling hit, and the metal fell in a way that shocked people who believed silver only moves slowly. The result wasn't just a correction. The result was a message When silver gets crowded, the system will demand more collateral, and the weakest hands will be removed first. In 2026, the elements rhyme again, but with a twist. The twist is that we now have a clearer view of the split between paper exposure and physical demand, because global markets are more connected and more transparent than ever. The twist is that flows can be tracked almost in real time, and regional premiums can be observed rather than guessed. The twist is that retail participation is massive, and the buy the dip reflex is now cultural. So who are the players in this episode? Start with the exchanges and clearinghouses that manage default risk, because they are the referees. When volatility explodes, they don't debate sentiment. They change the cost of participation. Then there are the brokers that transmit those costs to traders. And then there are the large institutions that understand this mechanism so well they position around it, not within it. There's also the ETF ecosystem, especially the giant silver products that serve as the public's on-ramp to the metal. In the days around the crash, retail flow reportedly pushed roughly $430 million into a leading silver ETF over just 6 trading sessions, with more than $100 million flowing in on the very day of the collapse. That's not a small statistic. That's behavioral evidence. It means a large number of participants were buying exposure while the market structure was tightening. And then there's the physical market, the part that doesn't care about candles. Physical buyers care about delivery, premiums, logistics, and refinery output. In China, silver prices were reported to trade at premiums of more than $14 above London benchmarks, a gap so large it can't be waved away as noise. Now we're at the heart of the dislocation. You had a Western reference price swinging violently, collapsing and rebounding, driven heavily by leveraged paper flows. And you had an Eastern physical signal pricing silver as scarce, paying up over benchmarks to secure supply. 2 data sources, 2 messages, opposite directions. This is the part no one is discussing carefully enough. Those 2 worlds can diverge, but they can't diverge forever. Either physical tightness eventually pulls paper prices higher, or paper liquidation eventually crushes the premium by reducing demand and freeing supply. The system must reconcile, and when it does, it tends to do it violently. To understand how that reconciliation happens, you need evidence that anchors the story. One anchor is inventory. London Vault data for silver offered a hard number, roughly 27,729 tons reported in vaults at the end of January 2026. That figure is not a prediction, it is a snapshot. And snapshots matter because they set boundaries. If inventories are abundant and rising, physical premiums are harder to justify. If inventories are stable or drifting lower, premiums become harder to dismiss. Another anchor is margin policy. A margin increase is a public signal that the system is treating the contract as more dangerous. It doesn't matter if you think the price should be higher or lower. If your position requires more cash and you don't have it, your opinion is irrelevant. The market will convert your position into a market order. And the third anchor is flow. When a crowd buys aggressively during a volatility spike, it creates one of the most repeatable patterns in markets. The crowd provides liquidity to the forced seller, but only until the crowd itself becomes the forced seller. In a leveraged environment, that flip can happen quickly. So let's make the mechanism simple. Imagine a crowded theater where everyone is standing on chairs to see better. Leverage is the chair. It works while the floor is stable. Then the floor shakes. The theater manager announces a new rule. Chairs now require an extra fee, paid immediately, or you must step down. The people with spare cash pay the fee. The people without cash step down. But stepping down in a crowd means bumping others. A few step down, they jostle more people. More people lose balance, and soon you have a cascade. That wave is the cascade. In futures, the fee is margin. The stepping down is liquidation, the jostling is slippage, and the wave is the crash. Now add one more layer, the options market. When silver accelerates, call options explode in value. Dealers who sold those options hedge by buying futures, which can amplify the move upward. Then, when the price collapses, those hedges unwind, adding selling pressure. The market's own hedging can become a feedback loop. That's why the snap matters. A snapback can occur when forced selling exhausts itself, and the market finds real buyers underneath, especially those who were waiting for a better entry after the run. But the presence of buyers doesn't mean the danger is gone. It means the battleground moved. If the battleground is now between physical tightness and paper deleveraging, the next phase is a contest over reference pricing. And that contest is where the trap or breakout question becomes meaningful. A breakout is what happens when the market absorbs forced selling, margins stabilize, and physical demand continues to pay up, pulling the paper price into alignment. A trap is what happens when the bounce convinces late buyers the worst is over, but the system continues tightening, liquidity remains thin, and another wave of forced selling hits before the market can rebuild depth. Historically, what does this data pattern suggest? When you see an extreme spike, a margin response, and a regional premium gap, the market usually enters a period of high volatility rather than a smooth trend. In plain terms, the next moves are often fast and emotionally confusing. The metal can rally hard, then drop hard, then rally again, while the underlying physical situation evolves more slowly. So what are the scenarios without pretending certainty? Scenario 1 is conservative. Volatility cools, margins stop rising, and silver consolidates, letting the physical premium either compress or persist at a smaller level. In this case, the market is digesting a shock, and price discovery becomes gradual. Scenario 2 is moderate. Physical demand remains strong, premiums stay elevated, and paper prices are pulled higher as the market relevers cautiously. In this case, the violent shakeout becomes the launching pad for another attempt higher, but with more controlled positioning. Scenario 3 is aggressive. The dislocation worsens, physical premiums signal stress, and any renewed margin or liquidity event triggers another sharp move, potentially in either direction, as the market fights over who sets the benchmark. In this case, the defining feature isn't the direction, it's the speed. What should be watched in real time? First, margin announcements and exchange risk updates because they change the math of holding positions. Second, ETF flows because they reveal whether the public is still adding exposure or beginning to retreat. Third, regional premiums and delivery indicators because they show whether physical tightness is easing or intensifying. And fourth, inventory snapshots because they provide the closest thing to a balance sheet the physical market has. Now look closer at how institutional movement actually shows up because it rarely looks like a single headline purchase. It looks like timing. It looks like who can hold through a margin change and who can't. When volatility spikes, some desks reduce not because they turned bearish, but because their models demand a smaller footprint. A systematic fund that targets a fixed volatility budget may cut exposure automatically. A bank's risk committee may cap gross notional. A hedge fund that was right on direction can still be forced smaller in sizing simply because the risk of another gap move is too high. At the same time, other institutions position differently. They don't chase the spike. They wait for the forced selling. They know that when margins rise, someone will need to raise cash, and that need is price insensitive. The first bids that appear after a cascade are often not emotional. They're opportunistic. They are placed at levels where liquidation is likely to hit because the buyer understands the seller's constraint. This is why the snapback can happen even when the news feels terrible. The bounce can be less a vote of confidence and more a signal that forced selling has reached exhaustion. Now factor in cross-market hedging. Silver doesn't trade in isolation. It trades with gold, with real rates, with the dollar, and sometimes with pure risk appetite. And when silver sprints higher, correlation patterns shift. Some portfolios hedge by shorting gold against long silver, betting on outperformance. Others hedge by shorting industrial metals against long silver, treating silver as partly industrial and partly monetary. When volatility explodes, those relative value trades can unwind, and the unwind can create selling pressure that looks mysterious if you're only watching silver's own headlines. This is why market dislocations are misread. People look for a single cause because it makes the story clean. But clean stories don't explain messy prints. The simpler explanation is that multiple systems all reacted to the same input. Volatility. Volatility rises, margins rise, leverage shrinks, hedges unwind, liquidity thins. Then price does something that looks impossible, even though every step in the chain is normal inside the plumbing. And when the plumbing is stressed, small frictions matter. Bid-ask spreads widen. Market makers quote smaller size. A stop order that would normally fill near the trigger price now gaps through multiple levels. If sell pressure hits during a period of thin participation, such as a time zone handoff, the move can be amplified. It just shows a cliff. Return to the physical premium gap, because it's the most important contradiction in this episode. A premium is a signal that someone wants delivery in a specific place. It can reflect industrial demand, investment demand, or logistics. It can reflect refinery constraints, shipping delays, differences in bar sizes, or sudden urgency. The key point is that premiums are local truths. They tell you what buyers are willing to pay for access, not what a global screen quote implies. When a premium grows large, it's tempting to declare that paper is meaningless and physical is everything. That framing is emotionally satisfying, but it can oversimplify. Paper markets are where global price is discovered and where hedgers manage risk. The problem occurs when paper leverage becomes so dominant that it can temporarily overwhelm the physical signal. A margin-driven cascade is exactly that kind of temporary overwhelm. Reconciliation can happen in multiple ways. One way is price. Paper prices rise to match physical tightness. Another way is premium compression. Physical premiums fall because supply arrives or demand pauses. Another way is substitution. Buyers delay purchases or switch products, easing pressure. The point is not to pick a path. The point is to recognize that the market is currently negotiating reconciliation, and negotiations are volatile. That's why 1980 and 2011 aren't trivia. They are case studies in how silver punishes certainty. Themes can be real and still coexist with violent shakeouts. People often lose not because a long-term story was wrong, but because the path required surviving a phase of mechanical stress. Normalization usually means volatility cools, liquidity returns, and positioning becomes less one-sided, so the next shock doesn't trigger a one-direction cascade. Until then, a snap is not a conclusion. It's the market revealing its wiring. You can even separate breakout behavior from trap behavior without pretending to predict. Breakout behavior tends to show follow-through after pullbacks, with rebounds that hold and gradually lift the lows. Trap behavior tends to show sharp rallies that fade quickly, with liquidity holes that reappear the moment volume spikes. Breakouts usually coincide with stabilization in the rules of holding the trade, meaning fewer sudden margin changes and less forced liquidation. Traps tend to coincide with rule instability again, where the cost of holding exposure changes abruptly. Another overlooked player is the industrial hedger. A manufacturer that needs silver months from now may hedge in futures to reduce cost uncertainty. When prices spike, that hedger may add hedges, effectively selling into strength. When prices crash, that hedger may reduce hedges, removing selling pressure and allowing rebounds. That behavior can look contradictory if you assume every seller is a speculator, but some sellers are simply managing budgets. If you remember only one line, let it be this. In silver, the move is rarely the message. The mechanism is the message. The move is what the eye sees. The mechanism is why it happened and why it can happen again, even if the next headline tells a different story. Institutions don't need to be right about direction to act first. They need to survive. They monitor volatility, funding, and clearing risk. Then they adjust. Retail often monitors price, then reacts. In a calm market, that lag barely matters. In a stress event, that lag becomes the entire event because the forcing function happens before the explanation arrives. So when silver snaps, the real signal isn't the scream on the chart, it's the quiet shift in rules behind the scenes. Now we get to the divide. The divide isn't between people who believe in silver and people who don't. The divide is between people who understand that price is sometimes a byproduct of forced mechanics and people who treat every candle as pure information. During episodes like this, attention becomes the scarce resource. The institutions that manage risk move first because they must. The retail crowd often moves last because it can. That's how information gaps become wealth gaps over time, not because one group is smarter, but because one group sees the mechanism. When margins rise, leverage shrinks. When leverage shrinks, the weakest positions are sold. When selling hits a thin book, price gaps. When price gaps, headlines appear. By the time most people read the headline, the forcing function has already done its work. So is this the breakout or the trap? The honest answer is that it begins as a test. It tests whether the market can absorb deleveraging without breaking the physical narrative. It tests whether physical premiums are signaling a durable shortage or a temporary dislocation. It tests whether the next rule change tightens the screw further or allows stability to return. And the deeper answer is that both outcomes can occur in sequence. Many of the most dramatic breakouts are preceded by the kind of trap that shakes out participants who were early, over-leveraged, or emotionally committed to a single path. The data shows that the snap is not the end of the story. It is the beginning of the negotiation. If this connected dots you hadn't seen, keep listening here today. This is Signal and Noise, where we decode what matters before it becomes a headline. The question isn't whether silver will keep moving. The question is whether you'll recognize the mechanism while it's happening, or only after the chart has already printed the lesson.